about smart contracts and impact for commercial financing transactions. So there are some things that probably some things you already probably hear about either in the literature, in the newspapers, on the web, on your feeds that you get concerning the use of technology in relationships. So there are a few sort of terminology that gets bandied about very often when we're talking about contractual relationships. And for our presentation, for the most part, we're not going to be talking about cryptocurrencies. So if you wanted to know about an ICO and what you do for initial coin offering and what the securities regulation is for Bitcoin, you can leave the presentation or the podcast. Okay, so we're not going to be talking about that. We're going to be talking about something that I think is more important and has the potential for fundamental changes as to the way that we contract and the way that we fulfill contracts. So that I think is something that is more interesting. And because I only do simple things and I just do financing, we're going to take examples from the financing space, although these things can be used in very different spaces as well. So you will hear very often the term distributed ledger. As kind of a broad brush, which of course will be in part true and in part perhaps not exactly correct, but in broad brush to give us at least a base to understand, what a distributed ledger is that you have a decentralized peer-to-peer network amongst computers, and that network establishes a ledger of transactions. And there are tools in order to be able to maintain the integrity on that ledger of the transactions. And as well, there's a consensus protocol as to how does that get changed. For example, it can be a unanimous. That is, everyone has to be in agreement with the change to be made to a particular ledger, and then that change is made. Everybody has agreed to it. Now, blockchain is a particular example of a distributed ledger, and the idea is you have blocks of transactions that are connected one to another. You could probably think about, I have initially a particular input that comes in. I have a way that input is treated and agreed, and then that gives an input after the consensus, which then links to another block in the chain or the transaction. So you'll hear things such as nodes, that kind of the computers that are connected and linked. You'll also hear things in the literature such as public versus permissioned, which I think is more like public-private, permissioned. And you'll also hear about, well, what's the consensus mechanism or protocol that's used in order to ensure the integrity of the ledger and any changes that are going to be done to the particular ledger. And there will be also, well, how and when is information input in, and then there's an application of the computer code to be able to have a particular result. So, and smart contracts are an example of an application of the particular computer code and interaction with these types of distributed ledgers or blockchains for a particular outcome. So there's lots that's being written about this. The reason I put this citation up is because I really wanted to say Lex Cryptographica. That's the reason I put it up. What you're kind of hearing is the following. And if you were to think about your legal history and think a little bit about the developments, of course, law is not always in the forefront of change. A lot of times law catches up. And as we were taught in law school, a lot of times what happens is custom becomes law. So, for instance, you'll think about lex mercatoria, the merchant law that kind of was, people did things a certain way, which wasn't necessarily supported by either legal decision or legislation, but eventually became the law because that was the practice. One of the great examples of that is the Bills of Exchange Act, is a perfect example of that, and that was revolutionary at the time from a legal standpoint and from a merchant standpoint. I believe, at least that's what we're hearing, is we are looking or participating in that type of transition towards something in our sphere. Okay, so Sterling, what is a smart contract? And you'll probably say to me, you know what, Sterling, I've heard on the street that a smart contract is neither smart nor is it a contract. So couldn't we just end the presentation or pass along to the questions right now? And the answer is, it is possibly a misnomer, the use of smart contract. I don't think it was coined by someone that necessarily was thinking that this was something that had to be adopted in legislation. Now, one of the kind of updated thoughts about what a smart contract is this one. We'll go through it, and then we're going to kind of pick out a few things that I would say constitutes for the community the promise of this particular technology. Okay? So, smart contract is automatable and an enforceable agreement. Automatable by computer, although some parts may require human input and control. Enforceable either by legal enforcement of rights and obligations or via tamper-proof execution of computer code. So this is not a definition that's adopted in Canadian legislation. There are some U.S. jurisdictions that are starting to kind of try and understand, habilitate, or follow this, although it really is at its nascent beginnings, if you could say it that way. So, what are some of the components here and the promise of smart contract? One of the words that you would look at is automatable. That is, you put that together with computer code, and the idea is that a particular outcome occurs because that's been hardwired. So there are inputs that are given to the code. So there's some factual inputs. Then the computer code works, and then there's a particular output. And the computer code is hardwired. It says tamper-proof execution. So it becomes immutable. You can't change it. And it's self-executing. You put the information in, the computer code tells you what happens, and then you get a particular outcome. Now, it does say that it is may require human input and control. That, I think, is an important question that we need to take away, and hopefully during the time that's remaining, we'll have some examples of what that could be and its particular application. Now, you'll also hear in the literature sometimes, this is particularly what ISDA is saying, because ISDA is extremely interested in smart contracts and its promise in regards to both document creation, fulfillment, and storage. So they make the distinction between smart legal contracts and smart contract code. Well, yeah, okay, well that's maybe good, but I think for our purposes what we need to do is take a much more functional approach. How do we take the technology, and how do we apply it to a part of the contractual relationship that we have, without necessarily getting pigeonholed and saying, oh, this is a smart contract, it ain't a smart contract, because I think that doesn't do justice to the promise of the technology for what we're doing. Okay. I thought that this would be a great example of a smart contract, a vending machine. So the first thing I would say is this is what I call a standing offer of sale, pun intended. Okay? So what we have juridically, I would characterize this as we have a vendor who is offering almost continually a particular selection of products to sell to those who would wish to buy the same. That selection is visible, so you would have to have particular sight in order to be able to see what the offerings are. And you are able to respond to this standing offer by doing something. So what would you do? You make a selection. You read some of the instructions. The instructions may say, please insert your money here. The instruction might be exact change, please. So you have to figure out if you do have exact change. So there are a few initial choices that you have. You put in your money. There's a verification of sufficiency of money. There's a choice of product that is done. So that constitutes then payment as well as choice, that there is therefore a binding sale agreement, and then you have the fulfillment automatically. The vendor can't come and say, well, let's negotiate. The price, I'd like to change that. There is no negotiation. It is automatic. Your particular product will fall down, or the particular USB key if you're a Captain America or something, and if you've hit it in the vending machine. So this, I think, is a good example of a smart contract. Can you imagine someone, after receiving their particular product, attempting to have a discussion concerning the vis cachet or merchantability? Or, oh my word, I chose the wrong thing after you have entered no, that's not the one I want. Can I return it, please? It's the same price. Could you give me another one? No, you can't do that, right? So here you have, I think, an example of if you will, a smart contract. There is the vendor physically doesn't need to be present. You have a particular fulfillment, and there is an inability to be able to negotiate particular terms to start out with, to reverse the decision once you have input the information, or even to negotiate about merchantability, return of product, or any other vis cachet that you think that there might be in a particular product. So here there is a human intervention. It has a legal significance to it because you have therefore a binding sale agreement. Now in the literature you will see a lot of times the reference to Boolean logic. Generally what happens with that one, it's if then, and that's very common in the computer code to determine, okay, well if there are certain either human intervention with facts, or if a particular application of computer code has given a result, if that's the result, then we go to, for instance, another particular result. Okay, so I believe that the promise of smart contracts is automatic, secure, certain, unchangeable, immutable, unchangeable, and efficiency. That's the promise of smart contracts. And what I'd like to do is I'd like us to test that a little bit. So some introduction from a legal standpoint. Our first question would be, is it a contract? We're going to test, say it says it's a contract, is it? So we take a look at least in the civil law. We're going to assume for the moment that we're using the civil law for our purposes of our analysis. A contract is an agreement of will by which one or several persons obligate themselves to one or several persons to perform a prestation. Well, we saw that at least if we were going to use computer code for a vending machine, that yes, it could constitute at least certain part of it could constitute part of a contract, right? It could constitute part of a contract. So the answer is perhaps. It depends what we're using it for. The next one is, well, what do we mean by intelligent? I'm not sure if you would say that intelligent in this context, or smart, actually is the same that you would get under an AI, for instance. AI, the proposition is very different with AI. AI seems to be a learning process that actually, where actually the technology is able to learn, reason. Not yet discretion, perhaps, but at least learn and reason. Whereas a smart contract or an contrat intelligent or intelligence is just simply it's self-executing. It just goes ahead. It's hardwired and it will do what it says it's going to do, as long as you've programmed it possible, which usually is the parentheses that's very important to check and ensure that you're going to get the outcome that you want. So if we kind of said, okay, well, Sterling, where is that in the civil code? Well, it ain't there. Is it a sui generis contract? The answer is potentially. However, I mean, we may in fact characterize this as maybe not necessarily a contract, but you may say, well, c'est un acte juridique. This is a juridical act. It's a consequence of or a part of. What comes to mind is our very robust and broad definition of what payment is. Payment under the Civil Code is actually performance. So you may say, well, you know what? The hard wire of the code is exactly that. It's telling me how the performance is actually going to occur. Think back to the vending machine. The vending machine has a particular way of performing. I don't have to negotiate when I'm going to have delivery of the product, right? Do I have to go and do something extra in order to get it, other than just reaching my hand in and hopefully being able to extract? So perhaps, to a certain degree, the smart contract can be payment or a particular execution or performance of what we're doing. So I believe what this does for us, it illustrates the necessity for lawyers and technology, for the developer to work together in order to be able to characterize intent, the intent of the parties. What do we want to accomplish, and what are we going to use this particular technology to accomplish for us, and how are we going to do that? Okay? Now, one of the interesting things that you'll see in the literature is, well, how can we really make this enforceable? Let me give you an example. Let's assume for the moment that what we have is we have a particular agreement that says, an escrow agreement, that says if particular conditions are fulfilled, then the money will be delivered to the vendor. Okay? Now, what you might do is you would say, well, the parties will agree on how it's delivered. That is it going to be by wire transfer? Is it going to be by check? So the parties could agree on that. Or what we could do is we could say it's going to be the following. That is, it is going to be in accordance with Schedule X. And what's in Schedule X? It's a hardwired code that illustrates what's going to happen, and the parties have agreed on the particular computer code, and it has the result that it goes to a particular account, looks for the money, then takes that money and delivers it directly without necessarily having to go through the intermediation of a financial institution. That could be one of the results. Now, the reason that you need to work together is, okay, well, that's what the parties have decided. Now, Sterling isn't able to read the code yet. He doesn't understand it. Okay? But there is someone else that can read it. So an expert is able to say that. We've integrated this into our particular contract. Would, for instance, if we had to go to the court and say, well, this is how it was supposed to work, it is supposed to work, something isn't happening there. Would we be able to have that quote unquote enforced? Well, if it hasn't necessarily already been enforced, and there's a consequence, or we have to revisit it and it has been enforced, the money has gone to the vendor, but we're saying, well, you know what, there's certain conditions that haven't been fulfilled. So I need to understand both the escrow contract as well as the particular fulfillment to understand. So we would likely have an expert who comes to say, well, this is what it means. The expert on the other side who says, well, this is what it means. If they are both in agreement, well, that's hopefully a good thing. Okay, and hopefully that's what we intended as the drafting. And I believe that by use of the code, we can get there by external clauses, what's a particular content. I believe that our civil law is sufficiently robust to allow us to take a step in exploring this type of particular technology. Now, generally what happens in nascent technology is, number one, there's always an overestimate of the impact in the short term, and generally underestimate the impact in the longer term. So let's continue on a little bit as to candidates for use of smart contracts. So what I have said thus far, you'll probably think, okay, now, Sterling, the example that you gave us was a little more as to performance, was payment. So I can see how, for instance, certain type of mechanics that can work. Generally, if it's an expression of logic and single consequence, or at least numerous numbered consequences where there is a choice or algorithm to be able to determine if that is appropriate, I think those would be candidates. So to try and think a little bit more about that, you would say from an operational standpoint, smart contracts have an excellent promise. We should be exploring that. We potentially also could be exploring that as an efficiency for purposes of actually coming to an agreement as to what a contract is, if we agree in that particular way. And that is, we could have it particular choices, and to say, I choose, I'd like a loan agreement, there's a particular template. Okay, what currency? Okay, US currency. What interest rate? US base rate, LIBOR. What frequency? What term? So we can have particular choices, and then it can produce from predetermined clauses something that is completely coherent as a draft for the parties to be thinking about. So it can, to a certain degree, be just simply a document assembly. Now, that stuff has been along since I was a young pup starting out in law. I used to do that at the very beginning with document assembly. Now it's got another cool name, smart contract, so maybe I should rebrand in order to be able to show that I'm doing something really cool and new. Okay? At least to be able to convince my partners that I'm doing something really cool and new, right? Okay. I think what is very important is for us to do a cost-benefit analysis. And when I say that is, what we want to understand is what we desire as the outcomes, what we're using the technology to simplify, make more efficient. Does that respond to the particular expectations of the parties? And are there any legal considerations that we have to take into account? And maybe smart contract is the way to do it. But it doesn't necessarily mean that that's what's happening. This giving in payment from the code is just to give you an illustration of why I think that the civil law is extremely robust and can be adapted to that. I'm hoping that our friends down the 401 don't necessarily disagree and say that it actually has to be common law that you have to choose. Okay, let's do an example now in the financing area. And the first example I want to do is letters of credit. Why did I choose letters of credit? It's because everybody has in their mind that a letter of credit is automatic. It operates automatically. And there's very, very little or very little input that you have to do, and the consequence is automatic. So let's go through a letter of credit without smart contract, and then we're going to take the proposition of smart contract to say, what could we use to be able to substitute for part or all of the particular steps there? And what are some legal considerations that we need to take into account? So a letter of credit starts with a relationship of a contract between what I've called applicant and beneficiary. That just happens to be A and B. Wasn't that great? A and B. So now, here I've used applicant and beneficiary. The example we could use is that the beneficiary is a vendor. Okay? And the applicant is the purchaser. And they happen to be just in different countries. And they don't really know each other. They really like the product that they've seen on the internet. They've signed the agreement. And there's going to be a particular delivery requirements that the beneficiary has to show that the thing actually exists and it's on its way. So what happens is the beneficiary really would like to be able to be paid. And the beneficiary says, you know what, I'm not really comfortable with your credit analysis for you. Is there some other way that you can use a mechanism that's automatic for me to be able to get paid? The applicant says, absolutely no problem. I'll be able to go to my bank. I have a relationship with this issuing bank. I'll be able to apply for a letter of credit. I've got some sort of revolving credit facility or letter of credit facility that allows me to do that. So there's a letter of credit that is issued by the issuing bank, but this issuing bank happens to be only in the jurisdiction of the applicant. So generally what happens is there's a quote-unquote confirming bank in the jurisdiction where the beneficiary is, and it's sort of a little like a back-to-back relationship, which says, well, the confirming bank is there. The beneficiary can take, because usually it's a piece of paper, takes the original of the letter of credit, fulfills certain document delivery, and says, okay, I deliver documents and a request for payment to the confirming bank. Confirming bank takes a look, all great, the documents are in order. Then there's payment, does a back-to-back with the issuing bank, and the applicant eventually will be able to receive its goods, be able to get them out, and the payment therefore flows. This has developed over numbers of years with merchant practice. There are particular codes that are accepted by banks and merchants and is very, very well known. Here, I think the first one that we want to take a look at is what's called a documentary letter of credit. What a documentary letter of credit usually is it's a means of payment. The example I gave was vendor and purchaser. That is, the purchaser is going to, quote unquote, pay for this through a letter of credit. The great thing about the letter of credit is it's independent of the contract between the beneficiary and the applicant. What the beneficiary does is looks at the letter of credit. It says, you have to give the following documents. So what would the documents be? Well, there's a bill of lading. There's perhaps a certificate of origin. There's maybe some sort of certificate of insurance. All that is set out or referred in a way that it's easy to know, yes, that's what it is. If they present those to the bank pays. The bank doesn't ask, is there any problem with the contract? Is there a default? Nothing. It's automatic. And I mean, Canadian case law accepts that. The Supreme Court of Canada, Angelica Whiteware, which was actually a Quebec case, acknowledges that is the law. You incorporate the terms and conditions of UCP, whatever number it happens to be, and that's exactly what happens. It's independent. So let's start out by asking ourselves, can a smart contract be able to make this more efficient? Well, you might say, we could set up the smart contract so that the smart contract or the code actually looks at the documents and says, yep, those are perfect. So it makes document acknowledgement that what is delivered is exactly what is required under the letter of credit, so it can actually accelerate the payment. So it can be faster. So instead of it taking 2 or 3 days for someone in a back office to take a look at it, then what happens is it uploads it, it takes a look, it says yes, then there's payment. Now, I guess one of the first questions you might ask yourself is, but Sterling, let's say there's a comma that's not in the right place, or maybe it's not exactly the same words, but it means the same thing in the industry. What do we do about that? First of all, I would say that's extremely common in the space. That happens considerably for documentary letters of credit. And usually there's a process where the bank takes that and then has a discussion, usually with the applicant, that says, this is not exactly the same. Do you feel comfortable of us proceeding to payment? And would you waive certain other conditions? We're happy to do that, but is this going to be sufficient? So if you were using a smart contract, you would need to have a little bit of a pause in your fulfillment. And you couldn't say, no, okay, yes, automatic payment. You could say that. But then you'd say, well, if it isn't exactly the same, maybe I need some sort of human input now. Who gives that particular human input? How do we feel about that? Is that appropriate in these circumstances? Would be questions that we would need to ask for this particular way of doing things. Now, there is something juridically that we would, as lawyers, we would need to be putting into the mix to determine if this is the appropriate thing to be doing. And what would go in the mix is the following. Let's say that there's some sort of fraud between the beneficiary and the applicant. That was acknowledged, and usually is acknowledged in the UCP, but is also acknowledged in the case law that says you can go to court and get an injunction that says to the bank, don't pay. Now, if you've hardwired that, and the documents say it's all good, and the hardwire says pay, well, maybe the applicant will want to say to you, there needs to be something else. There needs to be a particular question, additional question that's asked. Now, maybe what is the question that's asked, and we would have to, again, take a look and see is, okay, well, if there's an injunction, yes or no, well, that should be a public record. We should be able to go out and search a record, and then we have the computer code. The computer code says all the documents are cool. Now we have a different question that's asked. Is there an injunction? If there is no injunction, then I can go and pay. Now, well, this will require that the code goes to search somewhere else. Usually this is called an oracle. This is not because this is the fourth installment of Matrix. It's just simply that this is the word that's used for some outside necessity to put in some information. Okay? Now, then the question would be, okay, fine, not a problem. Where do I go? Is it available? What happens if it isn't available that day? Or what happens if the service no longer exists? Because I've hardwired it in my code. So you therefore you're asking yourself the question, okay, I need an appropriate oracle. I need to agree that we can go and say, no, there's no injunction, fine, let's move on. Or do we ask the bank to say, no, there's not an injunction? Well, that has a different variable in it. Or do we ask everybody to say there's been no injunction? Well, okay, but maybe the applicant says, I kind of would like to hold up the payment, so I'm going to waffle on going on to the particular ledger and saying, yeah, we're all cool. So I think there's some very important questions that are to be asked in respect to that. Now, the next thing we could say is, okay, fine, let's assume that we've got that. Is there any way, Sterling, that we could get rid of the issuing bank? Why do we need an issuing bank? If it's supposed to all be automatic, why have an issuing bank? Why don't we just say, okay, we'll have the algorithm, we'll have the documents, we'll be able to say, are these the proper documents? If everything is cool and there's no injunction, well, what happens is it goes to a particular account, takes the money out, and then transfers it to an account of the applicant, and takes it and sends it to the particular account of the beneficiary. Whether it's cryptocurrency or some other currency, we can deal with that. We'll figure that out. I guess you could do that. I see already Sylvia has some reaction to that happening. I'm going to anticipate maybe some of the questions that Sylvia has in her mind about that, because I start to have some questions about that. So let us think about some of them from a juridical standpoint. Because what we're doing is, as a lawyer, we're trying to help out and facilitate the use of a smart contract in this particular. Because the promise is here, we could eliminate the intermediaries. There'll be no problem. Okay. One of the things that you might think about is, if you're going to do that, your smart contract must be recognized juridically to have the same effect as a letter of credit, which is independent from any insolvency of the applicant. If we eliminate this and it's not a letter of credit anymore, well, maybe the code, the computer code will give an automatic response for you, but that has to somehow be acknowledged by the courts that can be outside of the insolvency. Because if the applicant has the particular money, the court will usually say, come on, we're freezing everything here. Okay? That's the effect of a CCAA or certain insolvency provisions. We're freezing everything because we need a little pause. We're going to figure out where that money goes. If that's the case, how is the beneficiary feeling? The beneficiary is saying, ooh, now just a minute. I'm substituting for an uncertainty here. That was the whole beauty. I didn't have to worry about your insolvency purchaser. I just was able to look to the intermediary for that. So that, I think, would be a very important question that needs to be asked. The next thing that the beneficiary could potentially say is, well, it's all cool, Sterling, that the computer code says, go to this account of the applicant, get the money and transfer it to me. But what happens if the account happens to be zero or less? Like, what have I earned? Great, I got this cool code that gives me a response, but if there's nothing to go and get, well, how am I advantaged? Okay, well, maybe the applicant can put it there. But the other thing that we need to remember is that letters of credit are not just a payment mechanism. They're a mechanism that is actually a financing mechanism for the applicant. The applicant doesn't need necessarily to have the money dedicated for the purchase right away when the letter of credit is issued, or even when the money is going to be drawn. That's a question between the issuing bank and the applicant. It could be there, it could be cash collateralized, but it could be collateralized by other types of things, even hard assets that are not necessarily easily monetizable for the bank. So the applicant may say, there's no way I'm putting the money up, because for me, that doesn't really help me in any event. So both the beneficiary and applicant may say, you know what, maybe we do need an issuing bank, at least for the moment, because there is no recognition in the legal community that this automatic way of doing things is going to be robust in insolvency the way that a letter of credit is. Okay? Now, in order to kind of complicate the letters of credit and the analysis, maybe what we should think about is there's also what are called standby letters of credit. Sometimes in the literature, particularly outside of the United States and Canada, in Europe, in other places, they call them bank guarantees. The idea being that you have a standby obligation on the bank to pay, usually on demand, and usually what it'll say is the beneficiary will come and say, I am entitled to get money under my contract between myself and the applicant. Please pay me. And the bank will go, yep, that's what we agreed. He's got the letter of credit. I got the document. I'm paying. Now, those types of letter of credit a lot of times remain over time. So there's some interesting questions that we would have to ask ourselves, again, from a smart contract standpoint. Let's start with one. The beneficiary, for instance, could be a government. The obligation could be, for instance, concern workers' compensation. It could be pension obligations. The other possibility is this could be some sort of project finance. And the requirement is that the issuing bank have a particular credit rating. Okay, well, how do we factor that in? How do we factor that in for this purpose? Because generally what happens is, if there is a change in the credit rating of the issuing bank, usually it says you got a certain amount of time, you can draw on it, and if I don't, in order for that not to happen, you've got to give me another letter of credit. So if we've hardwired this thing, should this be one of the questions? That is, if there is a change in the credit rating, where would we go for the credit rating? We have to have another oracle for that particular one. And then, okay, well, if there's been a change, passage of time. If there's a passage of time, then there's not been, has there been a replacement? Well, then there's some other intervention that I have to have. And if that intervention is, well, maybe I'm now have to figure out, I have to cancel the rest, or maybe I don't have to undo the rest because it'll never flow because I've kind of stopped it. So there are other questions that you would need to ask yourself when what you're doing is a standby letter of credit. Interesting enough, there's an Australian bank that has used distributed ledger technology for bank guarantees. Very interesting, very interesting. And there's lots of examples out there of use of letters of credit for export financing. Okay. I got so many examples. We're not going to have enough time. So maybe during the question period, we'll do some. The next one I wanted to do, what we'll jump to, is a syndicated credit agreement. This will have some other examples. So the first question that was asked me, now this is certainly one of the questions you get at a cocktail party, and I love talking about this at cocktail parties. And that is, Sterling, could I have a loan in cryptocurrency? And the answer is, why not? Sure, let's talk about it, right? So we advanced a little more during the cocktail, and we got some great ideas. So one of the things, of course, that we would be exchanging on is, what do you mean by, what is a cryptocurrency? What is it really a currency? Is that a misnomer? Certainly doesn't have legal tender necessarily, although lots of people accept it. It doesn't have legal tender, so you may say, strictly speaking, it's not a currency under the Currency Act, so it doesn't necessarily have legal tender. Is it a securities? Well, I mean, maybe it's not a securities for securities regulation, but it might be securities for us from just thinking about a securities transfer legislation. By analogy, you would say, well, how about my account with my broker? I've got this relationship with my broker, and that has some particular value. Is it a security entitlement under securities transfer legislation? Is it a commodity? Maybe it is a commodity. Maybe you'd say that. Is it just a general intangible? So there's some good questions to start out with that. The next question is, well, if you were choosing what law to have for your loan agreement, Sterling, of cryptocurrency, could you choose Quebec law? And I said, well, of course, why not? Then the question would be, but does Quebec law govern everything, Sterling? We would have to likely come back to say, okay, certainly concerning covenants, where there's a covenant that you can covenant contractually that you have to give me back cryptocurrency. You can do that. But are we really concerned about contractual, or are we more thinking about property rights in rem? That is, who is the owner of the cryptocurrency? Who can dispose of the cryptocurrency? Who can pledge the cryptocurrency if that's something that
those particular questions are important for us to be asking ourselves. Now, one of the cool things is that if you will remember going back to, and I don't know if everybody did a Roman law, the one you fell asleep at in your first year in law school. I said, maybe the Romans got it right. Because the Romans had the concept of being able to have loans of wheat, silver, gold, anything that could be kind of consumed. They had that concept. It was called a mutum. I don't know if I'm supposed to say mutum. Maybe that's what I'm supposed to say. But something like that, okay? This is, I think, to illustrate, and we've got those, we'd had that in the old Civil Code, and we have that in the new Civil Code. We've got a simple loan. What happens is, and this is what when I get money, it's a simple loan. That is, I'm not supposed to give back exactly the same the same currency to my lender. I give in same kind, right? One of the first things I worked on as a lawyer in the dark ages was a gold loan. We were doing a gold loan, and that was totally exciting to see how robust the civil law was to say, of course, the Romans did gold loan. Why can't we? It says it in the code. So yes, we can do that. And I think that independent of how you characterize, I think that you could have that. You will think to yourself, okay, well, Sterling, if I go into the securities realm, we've got securities lending agreement all of the time. And there, it's not that you have necessarily a direct relationship with the issuer. No, it's by intermediaries. And you'd have the securities loan all of the time. Why couldn't we could do the same thing with an intangible? If it is intangible, we could do the same thing with a commodity, if it's a commodity. So, yes, but that isn't the end of the story. I think as a lawyer, you would want to ask probably certain questions about that. The first question that comes to mind, particularly with some of the recent press about $200 million in accessibility of cryptocurrency vanishing, inaccessible. One of the first questions that you might ask yourself is, okay, I've lent you some Ethereum currency. If I get it back in a year or two, am I going to be able to use that? Like, is that all right for me to get, I lend you 10 Ethereum and it's fine for me to get 10 Ethereum back? Well, maybe. But that depends on your view of the ability to use that. Because maybe you're going to love to get 10 Ethereum back, right? Week 1. But in 2 weeks, you may not want to get 10 Ethereum back, right? Because it's complete. There's a value proposition. Now, you could say to myself, Sterling, don't worry about that. Don't worry. We'll go the derivatives market. We'll have forwards on Ethereum. Well, okay, good. I think we could probably do that too. But how deep is that market, right? Like, and is that really going to be able to? That also presupposes that there's a secondary market where this thing is actually churning, and you can get data points, and you can actually price this, right? So the answer is sure. we can do that. I guess one of the next questions you might ask yourself is, should there be an interest component? I'm not able to use the 10 Ethereum. And how do I calculate that component? Is that component embedded in the fact that I'll actually get 10 Ethereum at the end? That's what I'm going to get? So I don't need any interest because I'm going to get that 10. And that has now increased, hopefully, in value so that I get the value of that. From a borrower as well, the borrower will say, well, I get the 10 Ethereum. I'm going to convert that today into money, whatever currency, an actual currency, not a virtual, just that one, because I need it to pay, I don't know, to pay employees, to pay suppliers, and they're not accepting Ethereum yet. So, okay, great. They can monetize, but then they have to feel that within the year, they're going to be able to go to a market and be able to actually get that, to be able to deliver it under the loan agreement. So, great. again, I think it's robust, but we need to be asking ourselves some important questions. So in a syndicated credit agreement, what are some other possible uses of a smart contract? And you will see this in the literature. One of them could be, well, how about my conditions precedent? Could this not make it easier for the conditions precedent for disbursement? Could we not have a particular way? Now, many of us have had the experience in an acquisition financing where the only thing holding up is the fact that the money hasn't been received. I know some of my partners, they say, Sterling, we're closed. Where's the money? Like, why isn't it there? And you might say, well, the promise of smart contract is to make things more efficient. Couldn't we make instead of having to go through all of the particular ways of transferring money, couldn't we bypass that and use a smart contract in order to make that almost instantaneous? The answer is perhaps we should explore that. As we know, a lot of times the conditions precedent in financings have a certain amount of discretion. And I think it's important for us to sort of determine, can we use them for all conditions precedent? Can we use it for part of them? What sort of human intervention has to say, well, yes, the CPs have been met, and then the payment can flow? Is that what we're about? So I think that there are some important questions that we need to be asking ourselves. Okay. One of the next ones is, well, how about margins and interest calculation? Could we do that? Now, the answer to that one is, well, you might be able to do that. You might be able to actually simplify some of the back office in a financial institution to make the calculation of margins and interest applicable. How are some of those margins calculated? We've got a matrix problem, don't we? We've got an oracle. Because a lot of times it's based on a credit rating of a borrower. So you'd have to say, okay, fine, we go get that. We can hardwire that. What happens if it's not available? We need to think about that. And usually in your table, what happens if it's not available? Then there's a choice. You have to say, well, is it both S&P, DBRS, Fitch? Who is it? What do I do? How do I make the calculations? Those probably you can use computer code on. And then it would probably tell you, okay, well, this is a particular margin. You may have other questions, though. Part of the questions are, have I received the officer certificate that I'm supposed to get, the compliance certificate? Is it all right? Once you start doing that, then you have to ask yourself, how much can I invoke the computer code, and how much do I have to have human intervention? Another one sometimes is, have the financial statements been delivered? With a public company, again, maybe you've got an oracle that goes out, goes to the website, says, yes, they've been posted, no problem, then I go on. But you can kind of see that, come on, Sterling, you're going out for this, you're going out for that, you're having human intervention. What's the cost benefit? Talk to me about that. Is the cost of building that and having it applicable, does that give me a benefit? And the answer is, a lot of times the first mover is the one that pays the price, that pays the cost of that. And eventually there are others that come along and adopt that as an industry practice. So another possible way of having that to be used. Payments can be another example. That is, if I have to pay interest on a particular day, then we don't have to negotiate all of the time. I need 3 extra business days if it's interest payment because there might be a problem or administrative issue. It can be automatic. We could say, well, just go to account and then pull it and then distribute it to everyone. The administrative agent has less to do. It's automatic that the interest then gets paid and distributed to the syndicate members. That's a possibility. The same way, what can happen is, well, I've got a principal payment. I make the principal payment, and then it gets distributed. So the administrative agent has less to do. You get your money quicker. You're able to have payment quicker. Another one that you might say is a candidate is consents, extensions, and waivers. So this one goes, think in your mind that in a credit agreement, a lot of times you'll have things where it has to be everybody that agrees, and sometimes it's things where a majority has to agree. Sometimes it can be different categories. Who is the majority? Is it a supermajority in certain cases? Is it 66 and 2/3? Is it 3/4? Is it just 50 plus 1? How do we calculate that? Who participates in the decisions? So there can be a request. You can say, well, what we're going to do is we're going to use distributed ledger in order permission. So it's just our group. We're going to have a consent request. We'll have it a little like a blockchain, a consent request. Then we'll have everybody say yes, no, yes, no. And then once we've got the applicable consensus, the smart code the computer code will go through. The requisite number for consent A are fine. Therefore, this is agreed. And at the bottom end, you have a record of what the amendment is to the credit agreement, and is now memorialized for everybody to see. You don't have to involve Sterling to handwrite or even put it on iManage or any type of document. You don't have to do that. So that's a possibility. That can be a possibility. Part of the challenge comes when there's a little more discussion. One of the lenders says, well, I'd prefer not everybody see that this is a concern, and I particularly prefer that the borrower not see that I'm concerned about this. I'm going to see if I raise this, if anybody else in the syndicate feels like it. Because I don't want to have the borrower get their nose out of joint thinking that I don't want to do this, but there's a consideration here. So that would be something that you would have to perhaps have a thought about. Interestingly enough, in the literature, they're now starting to talk about, well, maybe what we can do is we can have a little bit of a sidecar. Well, that's interesting, because that's not the promise that was given of smart contracts. Smart contract says everybody is going to see. Everybody's going to see the transaction. Everybody's going to see and agree. So I think it'll be very interesting to see how that particular one plays out, to determine if that introduces any challenges. Now, events of default and recourses. Okay, now this is a one where I think borrowers should certainly raise their head and say, ooh, I'm not sure that I want this to be automatic, right? Like, I want you to take some time in going to the lenders and figuring out that there really is a default. I want everybody to vote on it. This, I think, becomes particularly the concern if we're not only in a syndicated credit agreement, but we're in some sort of like term loan B market, or we're in some sort of public issuance. You say, okay, well, like, how am I going to get everybody together to say yes? Like, they may have the computer, but if it's 5 years down the road, they've forgotten about their node. Right? They've forgotten their password. They can't go on. They don't even know. So you've got someone who is not even communicating with you. So yes, there's a lot of good promise. I think there need to be some things that are discussed, thought about in the process. So, not sure, Tanya, where we're to go on this one. Like, I'd love to talk about 3 other examples. Maybe we can start with the interest rate swap. Maybe stop here for questions. Is that a good idea? Yeah. And see. And if people say, Sterling, I'm bored out of my skull, could you please talk about interest rate swap in any event? I'd love to do that. But if you have any questions about any of the other ones, I'm happy to try and take them. Any observations?
Perfect. Thank you very much for the presentation. First, I just want to say I'm in favor for smart contract. I think there's some developments to be done to optimize the coding and the different risks. So my questions are mostly looking into these risks a little bit. I have 2, so depending on who's interested, maybe.
I can barely hear.
Oh.
So I'm not sure if it needs to be put into this part of the room.
Is this better?
I'll read your lips. Okay.
right? One day we'll have brain interfaces, so it'll be easier.
Okay, well, we'll have a
Um,
smart contract
exactly.
I'll get you.
So just a quick question. I wanted to come back to, you brought up the Ethereum issue at some point that happened where basically the digital funds were, or the Ether in itself became irretrievable or inaccessible because the coding in itself hadn't been properly wired. That's one of any inherent risk. I think it's also linked to what we call loss in translation. So you have the intent of the parties, which probably goes first to legal terms and conditions in human language, and it has to be embedded into a machine language or coded language per se. I would say in terms to avoid or to mitigate this type of risk, which is an inherent risk per se, I think we will go further with the coding, but is there any type of mechanisms or safeguards that the parties could consider to try to mitigate this risk? And my second question, if you want to think about it, I think just as a future lawyer going into this, we're familiar with legal terms and conditions, but we're aware that there's a certain ambiguity in term language. That's why we have a job. That's why we have a litigation department at some point. How do you look going forward with smart contracts? What type of partnership, what type of skills should a future lawyer look into for the future?
Sure. Okay, that's great. Thank you for that. The first one I would answer in the following method. Probably you've seen last year, National Bank said, we have done the first blockchain note issuance in Canada. I said, oh, that's awesome. I want to read about that. And so, first of all, it was 100 million, which, look, that would feed my family for a long time. But for National Bank, poof, that's probably a drop in the bucket. Okay? What do I take away from that is national, and interesting, you read a little bit more, and it looked like they were doing things in parallel. So what I liked about that was, let's do it. Let's try it. We're going to try it. So the payments, for instance, we'll use it just for payments. So we're going to automate the payments so the payments are faster, a distributed ledger, who's on it, who gets the interest, who gets the principal payments, those types of things to make it faster, if I could say it that way. So we'll do it in parallel. We'll see how it works. And we test it live with something that is real life. We don't just do one in a virtual test. And we'll see how it works. So I think that there needs to be a lot of that being done. I watched a fascinating video. It was great. It said, we now have an automated loan agreement. I said, this is awesome. So I went on, I looked at the video, and at the very beginning, it was document assembly. I said, hey, I used to do that. That is, okay, what do you want? Who's the borrower? Who's the lender? What's the address? Currency. They had a virtual currency, by the way. And they didn't have any discussion about concerns about the currency. So, great. We've got document assembly. That's good. I personally think that there needs to be more interaction between the lawyers and those who are out there. The part of the problem is the technology is so fast that, like, we're playing catch up. What I have said today was probably good 2 years ago, right? It won't be good tomorrow. It'll be some other mechanism. Well, that's great. We should be doing it. But my feel is, and I hope that financial institutions will take the time to be able to do les petits pas. Let's do this. Let's try it. See what happens. Of course, it's like the same adage. You never need fire insurance for your home until there's a fire, right? So, I mean, there should be maybe a broker right during the fire, but then the price would be exorbitant, wouldn't it? So, therefore, for certain smart contracts, you don't really need to be concerned unless it gets tested with something like a financial institution insolvency, right? There's a bail-in, there's some sort of regime, and the money's out the door because we got a smart contract. Is that what you want? Maybe yes, maybe no. Okay? Or a letter of credit where, okay, we're going to do away with the letter of credit. We're going to do what Sterling said. We'll just have it in no intermediary whatsoever. And then there's an insolvency. Well, what happens then? How does the beneficiary feel? How does the applicant feel? So, but there are smart people, smart people thinking about smart contracts. And this is not in just a self-executing sense that I'm using the word smart. They're thinking about these. ISDA definitely is very, very interested in this. LSTA as well is very interested in that. And I know there are regulators that are also kind of watchful as to what's happening. So it will perhaps take like a bad example for something to happen. Hopefully we can have more good examples than bad ones so that we can learn from them. Which then I think sort of dovetails, and the other thing is too that, well, maybe, for instance, in law firms, maybe we're going to actually need to elevate some of our tech people to actually be helping us draft contracts. Right? Now, that's on the podcast. I think that's probably now recorded, and we can probably diffuse that to our tech people this afternoon. Okay, Sterling says we've got a job for a long term at Stikeman Elliott. But I think that's important. It's important that we be able to understand, to be able to have that type of dialogue, and even start doing that. I know there are numbers of law firms who have thought about these particular things. But lawyers were extremely good at issuance pinpointing. At least we should be, right? And so we need to be able to have that. But it's, one size doesn't fit all. One size does not fit all. And where there is discretion, where the clients actually want discretion, or where the clients want a little breathing room, we're going to talk about this. Well, smart contracts, they can have a pause. They can have a pause in it. But then there has to be, well, does it get turned on again? And who turns it on? So we would need to have that type of, is it everybody? And maybe it is everybody, because their parties are supposed to agree, right? And you may in fact want some pauses sometimes, because you might want to say, it's like the fact, oops, I'm sorry, I didn't want the chips, I actually wanted the Mars bar experience when you've done the vending machine. And you have no way to undo that because you're getting the chips. And it's not easy to sell the chips to someone else, unless you sell it at a loss. I guess you could do that. But so those are, now what awaits for us? Because I know one of the other bylines sometimes was, this spells the demise of all lawyers. We won't need lawyers because the contracts will be smart. Where I see that proposition coming from is much more AI than smart contracts. In fact, in a couple of years, we may not even be using the term smart contracts anymore, because we'll be on to AI, right? Or some other version that has the use of technology, where we now delegate to artificial intelligence negotiation of 80% of the contract. And then they come up with, this is what it is. What have they looked at? I've looked at all of the precedents from Timbuktu. I've looked at all of the precedents that are available on Edgar. I've looked at all the precedents on CEDAR. I've looked at all the precedents that are in the bank, the Stikeman Elliott Bank. I have negotiated with the other AI that has access to the first three, but doesn't have access to the Stikeman and has access to some other ones. We have come up with the following clauses, which we can assay our market with the following criteria. So, to my mind, it's more AI that has that proposition to it, which I find very exciting. Because then we can do the real 20% negotiation where we can really add value, right? That the AI hasn't caught up yet. So that's kind of what I see. Are there some? Was that good for the questions? Yeah. Okay. Any others? Do we have some time, Tanya, or we don't have any time? I have 5 minutes. Okay. So in order to help you go to sleep for the we'll do interest rate swaps. Okay? Okay, so what is an interest rate swap? An interest rate swap starts with generally a relationship between lenders and a borrower. So there's a credit agreement and there are loans. Generally, these loans will be term loans. Okay, generally term loans. You could attempt to do it with a revolver. That's trickier. So we're going to assume we got a term loan for you know there's a one-time or could be multiple time disbursements, and then you have a particular schedule of repayment over time, and then there'll be a bullet repayment at maturity. And for this particular one, it's in a market where the term loan is actually at a floating interest rate. We're going to suggest that it's CDOR. So whatever. The borrower says, well, that's all cool, but I'm concerned that CDOR actually could increase quite a bit. And so, and that this could be a very long term. This could be, I mean, it could be a project where it's going out 10, 20 years. It could be even just 5 years, and you're a little concerned that maybe there's going to be some change in CDOR, and therefore you need to be able to, if you will, monetize or be able to say, well, I'm going to fix that risk. So what you'll do is you will be able to enter into a swap, an interest rate swap with a counterparty. Usually the counterparty is one of the lenders, but it doesn't have to be. It doesn't have to be necessarily, but that's generally the case in Canada. And the counterparty says, if you pay me interest on this particular notional amount on this schedule, the same day I will pay you interest on CDOR. That same day. So what you'll be able to do is you'll be able to take that interest and you'll be able to pay the lenders. So you'll be able to know for the next 5 years what it's going to cost you. You have therefore hedged your particular interest rate fluctuation, and absolutely not a problem. So where would you see smart contracts on this one? Okay, well, I'll guess for us. The first one that you might think about is, well, how about the payments, Sterling? Could we not have a calculation? Because it really is not great that we actually have a flow of payments. Why don't we have a net calculation of who owes what at a particular date? Isn't that how the ISDA documentation works in any event? So why don't we have a smart contract that is able to take the information? We'll need an oracle. So we need an oracle to go and get the CDOR, the particular CDOR rate. Hopefully it's available. Okay? So available, bring it, calculation, then who owes whom what, what's the amount, and then we can either tell the parties what the amount is, or if we can try and automate it a little bit more where we actually have a payment that's taken automatically and made. So that's a possibility. The other possibility is, Sterling, I've heard that ISDA contracts are standard forms. You can hardly ever negotiate those. So why don't we use a smart contract in document fulfillment, memorialization at the very beginning? Because we all know that there's only one standard, well, there's actually two, but there's only one standard contract. Then you've got a schedule. There are certain things that we have to populate in the schedule, certain choices. So why don't we make that an automated experience for our client so that we're able to have a document fulfillment, that we've got the master agreement, which never changes. We've got the schedule. We'll allow them to make certain choices that are pre-baked. They'll be able to see all of that. Then we'll be able to have that part fulfilled. Great. Possibly. That's something that would, I think, be necessary to explore. Then you would say, okay, Sterling, in the ISDA world, you've got that, but that never tells you what the actual transaction is. It's like the old Wendy's commercial, where's the beef? Like, you never know what the transaction is until you get to the confirmation, the confirm, which you can never really understand because you have to have the definitions, like who's doing what for whom. Okay? But so could we do that with a confirm too, Sterling? Could we have that fulfillment be easier? The answer is potentially we could do that. So you'd have to figure out that part. So document fulfillment. And you know what? I think that's going to be excellent if they can explore that possible document fulfillment. And ISDA is definitely knowledgeable about that. They definitely want to explore that, and they have particular principles that have recently been published. They've been doing that for the last year and a half to trying to explore this space. And the reason is that many years ago, almost in prehistory, before the crisis, there was a backlog. And trades were happening, but they just weren't papered. So here, maybe we're going to do better. The proposition of technology is maybe very helpful. We'll be able to paper better, which will be a very positive thing for the industry and for regulators as well. The same type of thing, because there is more and more regulation in this particular space, is that already has some sort of way where you can match. That is, there are reporting requirements for particular trades. You have to figure out who is going to do the reporting. There are certain representations that have to be made. ISDA has, like a Canadian representation letter, you can use a particular technology to match. That is, you give it as an end user, and then you say, and I'm going to match with CIBC, National Bank, and some other banks. And then the match happens. You don't have to exchange necessarily the documentation. So that's another thing that I think is worthy of exploration to make that efficient. I think that means we're ended. Is that right? Okay. So I'm going to take it a little bit more. I know that we have lunch, so that's very important that you get your lunch. Now, one of the things that you will have to be very careful about is the following, and that's what I'll call unwind. And that is, sure, we sculpt the payments that I'm getting from my counterparty to conform to my payment schedule under the loan agreement for my principal repayments. What happens if I want to repay early? I can. It's CDOR. I can repay early. But then that means I have to unwind my swap. Does that mean I have to unwind also the smart contract because the payment is going to be different now? Or do I have to have some sort of intervention with that? What happens on mandatory prepayments? Now this could be, for instance, an excess cash sweep. It could be some other event that doesn't happen very often, but there has to be a mandatory prepayment. That can also put that a little bit. So therefore, you have a risk of over hedging. Well, that's fine, but then you have to think about, well, how do I unwind that? How do I adjust that? What's my cost? How do I novate that? So there are some important questions you need to ask yourself concerning the use of smart contract once we get to that. I hope that you take away that I'm very excited about this topic. The proposition of smart contracts and technology is phenomenal. I think it's overstated in the short run, where people want to be sliced bread and attempt to corner the market, which is fine. That's a commercial strategy. We want to be very careful with how we use it. And in the financial area, there's important questions we need to be asking ourselves to ensure that it responds to the expectations of the parties and takes into account those expectations as well as some of the regulatory over financial institutions. Thank you very much. Have a wonderful, wonderful lunch.